It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome, everybody, to the Your Personal Bank Show, and we're going to cover a lot of great stuff today. But first of all, what are we going to talk about? Taking control of your money, creating tax-favored income, having access to more dollars in your lifetime. All good stuff. All right, so let's talk about your personal bank. Now, last week we were talking a lot about debt, and I know that's not a fun subject, but the reality is what we were doing was talking about debt and how to reduce it, which is a good thing. And the reality is the key is capturing interest rather than paying interest, because if you understand interest and compound interest in particular, if you earn compound interest, it can make a difference in your life tremendously in the positive side. And if you're paying compound interest, say like minimum payments on a credit card, it can certainly hurt you to the negative side. Your personal bank can certainly enhance and reduce the amount of interest you pay in your lifetime, which, by the way, according to credit.com, is over $250,000 per American in their lifetime of interest, not principal interest. Most of that goes to lifestyle, unfortunately, not to making a person's financial future better. So stop feeding the lenders. Stop making them rich. Capture that interest. Keep it in your own pocket and make the difference for you, your business, and your family. Now, today, the second key enemy to cash flow and financial success, the first was debt. The second one we're going to talk about today in a three-part series is tax-favored income or taxes. Taxes are never a fun subject to discuss. But it's a reality of our world, and we have to address and understand the tax implications of anything we do when it comes to our money. So the key is, when you look at a taxable, there's really three options. There's three categories, if you will. Well, I should say, let me back up. There's four categories of money when it comes to taxes. One is free money. It's free of any kind of tax. What's free money? Examples: inheritance. Another example is a match on a 401k, for example. That's free money, if you will. Some would argue it's part of your salary or compensation, which you could argue that. I can understand that argument, but in essence, from a tax standpoint, it's free money. We want as much free money as we can get. The problem we get that there is about free money is there's pretty limited options on free money, and we don't have a lot of control over those. You don't have a lot of control over when you inherit some money, for example. Now, there's also then, there's what's called tax-free money. Tax-free money, there's different investments out there that are basically on a tax-free basis. They grow. Some of them, if you access them properly, you can access them. Roths are a great example of that, where you can access the monies. You pay the tax up front and let it grow tax-free, okay? Insurance contracts do that. There's a few options in the financial world and in essence allow you to access tax-free money. Of course, there's tax-deferred money. And tax-deferred is primarily your qualified world. That's your IRA, 401ks, and those types of things where they're tax-deferred. What does that mean? It means you don't pay the taxes on the beginning, up front. You do pay it when you take it out or when you access it on the back end. So understand, tax-deferred just means you pay up front, you defer it. You kick the can down the road, if you will, and you pay it later, okay? And then, of course, the last one is taxable. So most sources of income fall under the taxable category. Of course, salaries and things like that, of course, do, and interest earnings and a lot of investment earnings and various different things are taxed. In other words, you pay the tax as you go. As you earn, you pay the tax. That's probably the most common one. Now, it's pretty obvious if you ask the question, which is the best, taxable, tax-deferred, tax-free, or free, it's pretty obvious. The higher you go up the ladder, if you will, the better it is in terms of how much of the money you get to keep in your pocket. And one of my mentors, 30-year-plus tax attorney, he's working on having as a guest on our show upcoming soon, hopefully. He shares a little concept called, if you think about it, it's keep your money above the line. Now, if you remember, we've got four categories, and if you even want to jot this down, it's not a bad idea. if you take a piece of paper and you write down free, tax-free, then draw a line under those two. So draw free, tax-free, a line under them, and then below the line, draw tax-deferred, or write tax-deferred and taxable. And here's the key to my tax attorney mentor's statement. You want as much of the money above the line as possible. In other words, you want as much of your money free or tax-free as possible, right? It's just that simple. So you want to look for ways. Now, do taxes make an impact on how much we have, how much of our money we have to spend and retire on? Well, yes. In fact, taxes, in some cases, can be the number one factor that would determine how much we would have to actually live and spend on, particularly when you talk about retirement accounts or qualified accounts. That's the IRA 401k world, okay? Now, I asked two powerful but simple questions when it comes to taxes. And the first one is, everything being equal, is it typically better to pay tax on the seed or the harvest? I ask that question when I speak around the country to different groups, and it's quite interesting. I get various answers, but the majority typically answer the harvest. I find that interesting. And here's why. We're taught to defer taxes now through IRAs and 401ks typically, okay, which is the seed, by the way, to then pay taxes later when we retire, or the harvest. Now, if everything's being equal, there's arguments both ways to this, of course. Everybody's situation is different, of course. I'm not going to say this is for everyone, but what I do want you to do is give it some thought, because what I find, this is very common out there, I ask people, have you given some thought and crunched some numbers and looked at the difference of paying tax on the seed versus the harvest? And in most cases, they haven't even looked at it. And I say, why are you contributing to this? Or why are you putting money into this deferred account? And the most common answer I get is, well, that's because what everybody else does. Well, if everybody, our parents used to say, if everybody else is jumping off a bridge, would you do it too? Is that a smart idea? Come on. What I'm saying is, look at it, consider it, and really gives it some thought. And I'm going to give you some thoughts to think about on why you should consider doing one versus the other. See, if you pay tax on the seed, you're paying tax on a much smaller amount of money typically, right? If you're paying tax on the harvest, if things work out, you want your money to grow over time, right? Therefore, you're going to have a bigger pile of money that you're now paying taxes on if everything works out like you want it to, okay? Now, just on the surface, think about that a minute. Again, everything being equal, do you think it's typically better to pay tax on a small amount or a much larger amount? You see where I'm trying to say? Now, the reasons we're told we should defer our tax now, and I love this one, by the way, I love it when people tell me this, is you're going to be in a lower tax bracket in retirement. Now, my question is real simple. Is that a good goal? Why do I ask that? Well, if you're in a lower tax bracket in retirement, doesn't that mean you're making less money? Is that a good goal? And by the way, this dirty little word out there called inflation, things do tend to increase in prices over time, don't they? Last decade, not so much, but generally speaking. And here's the thought I want you to think about before we go into more about taxes. And it's this. We tend, I don't care what your faith is, but we tend to get what we focus on. And if your focus is to be in a lower tax bracket in retirement, that means your focus is saying, I want to make less money in retirement. And again, is that a good goal? Next segment, we're going to talk about the future tax rates and how they're going to impact retirement accounts. Contact us at 866-515-6280 or yourpersonalbank.com. Love to talk to you and see how this could fit for you.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking about taxes. Fun stuff, right? Actually, it's very pertinent because, We're coming up on the second biggest tax day of the year. Most people don't realize this. Of course, we all know about April 15th. But October 15th is tax filing deadline for all of you folks, like myself, who filed extensions. So it's considered the second biggest tax day of the year. So it's a good point to talk about. And we're talking about how taxes impact you, particularly with tax-deferred or qualified accounts like IRAs and 401ks. We talked about in the last segment where there's 4 types of money. There's free money, there's tax-free money, there's tax-deferred money, and there's taxable money. The one I'm focusing on the most right now is that tax-deferred, because so many people do IRAs and 401ks and contribute to them without really understanding the ramifications long-term of how it's going to impact them and their retirement. And so the question is always asked, is it better to pay tax on the seed or the harvest? In other words, should you pay taxes on a small amount or, hopefully, a much greater amount down the road? Now, again, I can't answer that question for you right now. We'd have to sit down and talk about it and analyze the numbers both ways. But it is at least worth considering without just blindly doing it because, well, everybody else is. So here's the thing. As I stated, the reason to defer tax that we're given is you're going to pay a lower tax in retirement, or you're going to be in a lower bracket in retirement. And I always say, hey, that means you're making less money in retirement. Is that a good goal? That shouldn't be your goal because we tend to accomplish what we set our mind to. By the way, one of the questions always asked is, who created the IRA and the 401k and the Roth? Well, of course, Congress did. Now, the 401k was created in 1978, the IRA in 1981, the Roth in 1997. Here's the thing. In the bigger scheme of things, these type of accounts are relatively new. They haven't been around for decades and decades like many of these other financial tools that we deal with. And realize something. If Congress creates something, and I'm not going to get into a political discussion here because I don't think that's the point, but I think most people would agree, if Congress creates something, is it typically in their best interest or ours? Now, again, that's a question you have to answer. I can't. But what has happened, the end result, particularly if you look at the baby boomer generation who are now retiring, hitting that age 70 and a half, where they have to take money out of those IRAs and 401ks, whether they want to or not, it's creating exponentially larger tax revenues for the government. Why? I've been in a number of conferences with economists and things like that have stated, look, a big portion of our debt, our national debt, is going to be paid by the RMDs, which is the required minimum distributions of the baby boomer generation. Why? They took a small amount of money, deferred it into an IRA or 401k, for example. It grew over several decades, creating a much larger pile of money than is now forced to be taken out, again, whether they want to or not, and being taxed. Now, I've worked with a lot of folks. We have almost nearly 5,000 clients with our company. Many of them are retired. And I hear this as a constant refrain. When they look at their IRA and their 401k, they'll look at me and they'll say, and they're looking at the taxes that they're having to pay on it now, I get this constantly. If I really knew how this was going to work, I would have never done it. I get a lot of regret from people. So one of the things we say is, look, consider not funding an IRA 401k, and consider not building in our industry what's called a ticking tax time bomb. Now, there's exceptions to the rule, of course. Again, this doesn't fit everyone. One exception I'll give you is this. If you have a 401k with a match, take it. I mentioned earlier one of the 4 categories of money was free money, and your 401k match is one of those. It's free. In other words, if you contribute 6%, which is a pretty standard amount these days, and your employer matches with 3%, so 50% of your match, your account loses a third of its value. Did you lose any money? No. It was the company contribution that was lost. So the reality is the downside protection, you've got a nice cushion there. And, of course, you're getting free money going forward, so you got more. 401k company matches are great, in my opinion. But to put stuff in beyond that and create a bigger and bigger tax time bomb starts to not make sense. And I use an example here. Let's say for a minute you contributed $1,000 into an IRA or 401k. And let's assume, to keep things simple, that you're in the 25% tax bracket, state and federal. Well, you basically would have deferred $250 in tax, right, on that $1,000 you contributed. Now, let's assume $1,000 doubled a couple times over time. You had a great advisor, and they did a good job, and everything worked out like it was supposed to. Now, that $1,000 doubling a couple times would turn into $4,000, right? Now, let's assume for a minute you're in the same tax bracket, state and federal, 25%. We'll talk about that in a minute. You would actually pay $1,000 of tax of that $4,000 account. You originally contributed $1,000. So in other words, you paid in tax what you contributed. Did that work? Maybe. Some people argue, well, you got the deferral, you got the use of the dollars in the meantime that, to do something else with. But literally last week, I was talking to a CPA client of mine, and he made a very over 20 years CPA, has several CPAs in his firm. He made a statement that I thought was very astute. And he said, look, yes, you get tax deferral. That's true on these IRAs, 401ks. By the way, he wasn't a big fan. He said, but what I see in the overwhelming situations is this, that $250 in our example of deferral of taxes, people didn't take that money and invest it and build more opportunity or enhance their cash flow or build their retirement, enhance their retirement. They spent it on lifestyle. So if you get the tax deferral and you, in essence, spend it, where's the benefit? Now, I want to get to the next thought here, but you're listening to Money Radio on KFNN, 1510 AM and 105.3 FM. And if you want more information on this, contact us at 866-515-6280 or at yourpersonalbank.com. Now, let's continue this thought. Here's the thing. I love this one. I'm going to be in the lower tax bracket in retirement. Okay, well, is that a good goal? Most people get that one. You tend to get what you focus on. But I love this one too. If you do defer your tax and you do go into retirement and you have a larger nest egg, and let's assume you're even in the lower tax bracket, typically you'll pay more in taxes in total dollars overall because it's just a bigger pile of money, isn't it? And unless you took that difference of those taxes and invested it and made more with it to build your retirement or build your nest egg or whatever, you're not ahead, are you? Like that CPA friend of mine stated. Now, here's my second powerful thing about taxes and retirement accounts. The first thing I said was this. Should you pay a tax on the seed or the harvest? Again, you need to analyze that. We can be happy to help you do that, determine which way makes more sense for you. But here's another thing. What are the future tax rates going to be? Think about it. You're deferring your tax to a future unknown rate. Where are taxes today? Well, forget the politics about it. The statistics are real simple. The fact of the matter is we are currently in the third lowest tax bracket environment in history. Coolidge was the lowest. Reagan first term was the second lowest. We are currently in the third lowest tax bracket rate situation in history. So you're deferring taxes at a historical low to then pay them in the future on hopefully a bigger pile of money at a future unknown rate, which certainly could be higher. When you start to think about it that way, you start to ask the question, does this even make any sense? And lastly, we all know there's all kinds of rules, age limitations, contribution limits, penalties, taxes, government changes the rules. And what if the rules, the government's rules, don't fit your plans? For more information, contact us at 866-515-6280 or yourpersonalbank.com. Love to sit down with you and discuss this and determine if this is a good fit for you or not. Take a look.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We've been talking about a fun subject today. That's taxes. It's one of those necessary evils, death and taxes. But you know what? Here's the thing. It's something we have to deal with. We need to understand, and you want to understand the impact of how taxes affect your money. And we talked about the 4 types of money: free, tax-free, tax-deferred, and taxable. We've talked about moving your money above the line. The free and tax-free are above the line. Tax-deferred and taxable are below the line. And you want to move as much of your money above the line as possible to keep as much as you can. Why is this so important? Well, it's really simple. Let's assume you had a retirement account, a tax-deferred account of some sort, and you pay the tax going in, you defer it as it grows, and now you get into retirement and you start to take it out to supplement your retirement, or, as we all know, age 70 and a half, you're forced to, and you start taking your money out. What happens? Well, if your money is tax-free and you have $100,000, I'm going to use an example of a $100,000 account to keep things simple, and your account's tax-free, how much of the money is yours? The full $100,000. If your money is subject to 15% taxes, that's the bracket you're in at the time, you take it out. How much of the money is yours? 85. If you're in the 35% tax bracket, state and federal, when you take it out, how much is yours? 65. Do taxes make an impact on your retirement money? And the answer is yes, absolutely, big time. Sometimes the number one factor determining how much money you would have. So again, moving as much of the money above the line as possible is key, and your personal bank helps you do that. Move it into that, operate it correctly, structure it correctly, into that tax-free section. Now, before I jump into this on how your personal bank would work and minimize taxes, I'm going to be in Los Angeles, September 28th, at the Los Angeles Real Estate Grand Expo. There's over 50 vendors there. I'll be having a booth. You want to meet me, or if you know of somebody who would like to meet me in the Los Angeles area, come check it out, because the focus of that expo is how to invest in the shifting market. It's going to be a great time. Love to see you there. All right, let's talk about your personal bank and how it can benefit you in terms of overall tax reduction. Now, as I always say when I talk about a personal bank, you've got to understand how a bank works. If you're going to operate a bank yourself, you've got to think like a banker versus an investor. I've shared this before, but this is worth repeating. It's so important. A investor, which is what we're taught to do, trades hard-earned dollars for assets with the expectation the asset will increase in value, focusing on potential gains, typically only with little or no recourse if things go wrong. In other words, if the account goes up, your investment or the asset goes up, you make money. If it loses, you lose. That's not how bankers operate, because the bottom line is, we all know a stock, a piece of real estate or a business can vary in value. We don't know where it's going to be worth in the future. And if you only make money on the way up and you can't make money on the way down, or there's no downside protection, it's just another form of gambling. So what's a banker do? Well, banker, basically, they create cash flow through our payments. We take mortgages, car loans. We make the payments. If we don't make the payments, the banker takes the asset, sells it to somebody else, and creates payments from the other person. Are they really risking their money? And in most cases, collateralized loans, that's where you sign, and they have the recourse to take the asset, the car, the house, in most cases. In most cases, the answer is no. Bankers don't lose money. They protect the downside. What bankers do is create a cash flow and protect the downside. You want to think in those same terms. So a personal bank does the same thing. When you set up an account and you deposit funds into it, and understanding, again, how banks operate. If a traditional bank, you walk in and you open an account, you give them money, then the next person walks in the door, gets a car loan. Do they give them the money you just gave them? No. They put it in the safe, borrow against the asset. Cash is an asset. Can you borrow against an asset? We do it all the time with cars and houses and various things. Basically, banks earn compound interest on our deposits. They accumulate cash. What banks do is they accumulate deposits, our money. Well, you can do this and then have access to that money to create cash flow. You can do the same thing. I spoke about this last week. Access to capital is one of the number one keys to financial success, whether it be an opportunity or whether it would be an emergency. Either way, you're either going to take advantage of opportunities when they present themselves, Or when you have an emergency and you need money, you'll have access to cash without penalties or tax consequences. Or worse, if it's market related, you sell at a low. I saw this in 08-09. This was a common occurrence. A lot of people nearing retirement had a lot of their money in market related assets, lost their job because the economy was bad. They were nearing retirement. They'd built up a nice nest egg, and guess what? They had no income anymore. What did they do? Many people, we know this, the studies and such have shown that many people tapped into their IRAs and 401ks, took money out, took the hit, took the tax penalty. Sometimes, they had to pay the tax and the penalty in many cases, depending on age. And on top of that, it's like kicking a dog when it's down. The asset had dropped in value significantly, and they sold it at a time when it was worth a third or half of what it had been worth previously. That's kicking a dog when it's down. And the thing is, when do those assets lose value? Typically, bad economy. When do people tend to lose incomes? Job, business income, whatever. The same, a bad economy. So it's like a cycle of things that work together to really hurt you when you're down. Irregardless of the economy, the market, interest rates, trade wars, or anything else for that matter. If you want more information on this, contact us at yourpersonalbank.com or toll free 866-515-6280. I'd be happy to talk to you about how you can create that asset that would not only reduce your taxes, but create some safety, consistency, and most importantly, access to capital. And I can even show you how to have access to capital short term while being able to protect the long-term compound interest that is created on any account over time to supplement your retirement. You can have both the short and the long-term growth. Short-term access, long-term growth, without defeating that compounding effect. It's very powerful. Now, again, a personal bank is guaranteed and insured, no downside market risk. You have access to capital, earn interest, and you can be tax favored. Now, again, the contract has to be structured properly to make this, and you have to operate it properly. You can mess this up, okay? I hear stories, people, I talked to somebody and I looked into this or even did it and it didn't work out like I said. Well, there are ways to mess this up, and we walk people through this on how to do it. Now, the financial tool we use, we can use any financial tool, frankly, but for the personal bank concept, but the one that works the best, insurance. And it's a very specific type. It's a high cash value type contract with specific riders to make it work properly. And it's structured properly. We want compound interest. We want more money every year, right? We want no risk of loss. We don't want to borrow against an asset that can lose value. That's a recipe for disaster. Liquidity, want access to funds. CDs, annuities, some annuities have safety, CDs. They don't have anywhere near the kind of liquidity that we may need, again, for an opportunity or an emergency. So the whole IRA 401k world is off the table. And again, we want tax-favored growth, withdrawals, and to the heirs. And again, no other financial tool does that. Again, has to be structured and operated properly. My biggest challenge, people view insurance sometimes as an expense versus an asset. They look at it and say, I paid the money, I paid the home and auto bill and all that, and last thing I need is another bill. Stop listening, miss the whole point. That is not what I'm talking about here. So, again, there's three options: fixed, index, leveraged, and we're going to go into those options and how to access funds from these accounts. There's multiple ways to do so and build the long-term tax-favored growth that we all want. Contact me at 866-515-6280 or yourpersonalbank.com. Love to talk to you about this and see if it's a good fit for you.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. We've been talking about a lot of great stuff today and regarding taxes. Like I said, lots of fun. But we've been really talking about how to reduce those taxes long term, how to have your money be more above the line. Remember, the There's 4 types of money: free money, tax-free money, tax-deferred, taxable. And the free and tax-free monies are above the line. You want as much of your money above the line as possible, and your personal bank allows you to do that, again, if you operate it correctly. Now, there's 3 different types. Oh, and one other thing before I jump into this. There, as far as taxes go, is it better to pay tax on the seed versus the harvest? We discussed that earlier. That depends on everyone. But, Roths and things are popular because you're paying on the seed and letting it grow tax-free long term. What I find interesting is the IRS limits how much you can contribute to a Roth. And one of my CPA friends who jokingly says, whenever the IRS limits something, that means it's usually pretty good. So give it some thought. Consider it. And then, what are future tax rates going to be? We are currently in the 3rd lowest tax bracket environment in history since the beginning of the income tax over 100 years ago. If we're deferring tax at a historically low rate, what is the rate going to be when we need it or have to access it down the road? Certainly an unknown tax rate in the future. Could be higher. The reality is, if you're already taking on market risk, now you have to add potential tax bracket risk. What's it going to be? You're adding on additional layers of risk to your retirement money. This is one of the things I say to people all the time. With retirement, you have a known quantity of need. In other words, you know how much you're going to need in retirement, or we can calculate that pretty accurately. What's your expenses? How much is it going to cost to live? I'm not talking about the extras, just the basic costs: food, housing, clothing. Okay, we can put a reasonable rate of inflation on that depending on your age, and we can determine what your needs are in retirement. To risk that known need, in many cases doesn't make sense, does it? To put that at risk and put it on multiple layers of risk. In other words, market risk, tax risk. Why put all that risk on a known need? One of the statements I say to people all the time is, let's calculate what you know you're going to need, again, with a reasonable rate of inflation and a reasonable estimated tax rate in the future. Let's put money away through fixed options, guaranteed options. There's various types of tools that can do that. The personal bank contracts can do that. Some annuities can do that. There's various financial tools that can guarantee that you'll have that income at the amount that you know you're going to need. And if you want to put the rest at risk and move on, try to accomplish something more with the remainder, go for it. I'm not here to tell you what to do or not to do. That's not my role. But my point is, protect what you know you're going to need. And that's really that's the issue that I want you to really seriously consider. The last thought on that, I mentioned annuities. There's a lot of great annuity tools out there. And some people are out there saying, well, annuities are bad, or this financial tool is bad, or that financial tool is bad. No, the financial tools have a specific purpose. They're designed for a specific need. And they're agnostic. Tools are agnostic. Okay? And there's some tools that are better than others, no question. But the reality is they're there to do a job. They're not emotional. And you shouldn't be either. You should look at it and say, what's my need and what's the tool that fits the need the best? I use the example of you can have a sports car and you can have a pickup. Both will get you from point A to point B. One certainly can get you there a whole heck of a lot faster than the other. But if you're moving and you're carrying a lot of stuff, you'd rather have the truck than the sports car because it's way more efficient. In other words, what's the purpose? What are you trying to accomplish? Let's find the tool that fits that the best. So when it comes to that, like with the personal bank, for example, we're talking about access to funds, minimizing taxes, maximizing tax-favored monies in retirement. Have access now with long-term tax-favored money in retirement. Well, there's several options. There's fixed, there's indexed, there's leveraged. Each has positives and negatives or trade-offs, if you will, on what they do. Fixed is consistent and steady. For some people, that's the best fit. Index has potential for double-digit growth with no downside market risk. Others, that's a great fit. There's a leveraged option where you partner with a lender and leverage your money 3-to-1. For the right person, that's a great fit. We can look at any or all three depending on your situation and what makes the most sense. Again, what are you trying to accomplish? Are you trying to maximize cash, or are you trying to maximize death benefit, for example? We'll structure a tool very differently for each of those purposes. Now, before I get to my next thought, you want more information on this, contact us at yourpersonalbank.com or toll free 866-515-6280. Love to sit down with you and share how this would fit for you and see if it is a good fit for you. One other thought on that. I get people all the time, hey, I've looked at a cash value tool, and it just didn't work for me because it didn't have any money in the first several years. And I say to them, that's because your tool wasn't structured correctly. Here's a good rule of thumb. If at least 50% of the cash that you contribute is not available day one, that tool is not structured to maximize cash. That financial tool, that insurance product, is designed to maximize death benefit. Let's talk about that in a minute. 99% of insurance contracts easily, somewhere around there, let's say well over 90, let's be conservative, are really designed to maximize death benefit. That's their purpose. It's a death benefit protection tool. It's not designed to grow cash. It may have some cash, it may have a minimal amount of cash, but it's not designed to enhance significant cash. I met with an attorney last week who showed me the numbers on an illustration of a tool she was told was designed to grow cash. The amount of cash available in her account for the first year was 0. Now, just on the surface, think about that a minute. Does that sound like a cash accumulation tool? No, but many insurance agents and advisors run around telling people that it is. Was there cash in year 2 and beyond? Yes. But the reality is it was heavily weighted. Again, think of a teeter-totter. You got cash on one side, death benefit on the other. It was heavily weighted towards, or more so weighted towards, the death benefit side. It had no cash the first year. Again, I stated this earlier. If you're trying to grow cash accumulation, grow cash in your personal bank, high cash value vehicle, 50% of the money you contribute should be available in cash day one, first year, or more. If it's not structured correctly, or it's the wrong product, or, sad to say, the advisor may not understand how these really truly work. I educate people on this all the time. Or lastly, could be a commission issue in terms of how they get paid. Here's the reality, folks. I'm tearing the veil back in terms of how getting paid. That's full disclosure. When an advisor recommends one of these insurance tools that has cash and has death benefit, and most of the money is going to the death benefit side, there's little or no cash the first year, do you think they're getting paid by death benefit or cash? There's little or no commissions or fees or whatnot in cash. It's in the death benefit contract. That's the reality. So again, if you want to maximize a cash tool, accumulation tool, we'll show you how to do that on a tax-favored basis, both for short-term access and for long-term retirement, college education, supplement your business, a credit facility for your business, or any other type of purpose that you have. If you've looked at this before, I encourage you strongly, and the numbers didn't work out like you thought they should. In other words, there's little or no cash in the first years. You were looking at a tool that was structured incorrectly to what I'm talking about. Again, I'll say it a third and last time. Rule of thumb, 50% plus cash available of your contributions first year. If you looked at numbers that did not look like that, and based on my experience, well over 90% of the time when I look at these illustrations, that's exactly what I see. Little or no cash in the first few years. The tool is either wrong or it was structured incorrectly for whatever reason. So again, I strongly encourage you, if you have looked at this, take a second look. Contact us at 866-515-6280 or yourpersonalbank.com. My name's Ference. I've been doing this for 22 years. I've met with hundreds and hundreds of people who are clients today, and we are changing their financial future dramatically. Tune in next week, noon, Tuesdays, KFNN Money Radio.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.